Hey guys, Sunny Singh here. Thanks for tuning in to the podcast. There's 1,000,000,000 bazillion podcasts out there, but you chose to listen to this one. So I appreciate that. Today, we're going to talk about something that you've probably heard, or maybe you haven't heard. It's a great program. It's been around for a while now. It's called a DSCR program. And what this stands for is debt service coverage ratio. And essentially, how it works is it allows a consumer to be able to buy a home without having to put forth any documentation for income other than the proposed rental income of the property. Let me say that in a different way. You could buy a house right now without having to show any of your income. The only thing that you'd have to show is a rental agreement. And as long as that rent offsets the mortgage, you can get a mortgage to purchase a home with as little as 20% down. Isn't that crazy? This is called a DSCR mortgage. DSCR loans fall into a category of home loans known as non-QM mortgages. When we hear about non-QM, the first thing we think is non. What's that mean? Is that bad? Non-QM just means non-qualified mortgage. So rather than a conventional loan or an FHA loan or VA loan or a USDA loan or your traditional jumbo loans that have a set of guidelines that are pretty similar, as far as what the bank's going to verify for your income, your assets, your identification, your, sourcing your down payment, et cetera, your reserves. Well, non-QM lenders have their own set of guidelines. They're going to make their own set of rules. And those guidelines happen to be a lot more lenient than your traditional conventional FHA VA. So there are many different types of non-QM loans out there. This whole niche non-QM genre of loans, this category has really grown over the last 4 years. Some programs that you might not even have heard of that exist are a 1099 only program. What does that mean? You can actually just show your 1099 for the year and use that to qualify. Historically, folks that were on a 1099, self-employed individuals, independent contractors that are on a 1099, they typically, many of them report, write off a lot of deductions. And this ends up causing them not to be able to qualify for a mortgage. Not anymore. There's a program out there, the 1099 only program, where you just show your 1099. Let me give you an example. I have a client who's a truck driver. He's in transportation. His 1099 was close to $125,000 a year. On his tax return, on his Schedule C, his net tentative profit was only around 14 to 15K. He was writing everything off. When you add back what you're allowed to add back, which are depletion, depreciation, some other items, his total adjusted net income that he was able to use was close to 30K. So he wasn't able to qualify for much. Not anymore. We were now able to use his $125,000 1099, what he had as far as income before deductions, and this allowed him to be able to qualify for a much larger purchase price and get into the neighborhood that him and his family desired. Another program that's becoming really popular, has been really popular, is the 12 to 24 month bank statement program. This is a really cool program. We use the deposits from your business or personal bank statements, and we add them all up for the year, and then we multiply that by 50%. In some cases, it could be higher. In some cases, it could be lower. That gives us a ratio that we can use. So let me give you an example. Let's say somebody is self-employed. They write everything off. They take all the max deductions they're allowed to, or maybe they just had a lot of deductions because it's their first year being in business. And so, on their S corporation or their business returns or their personal returns on their Schedule C for their profit and loss, it shows they don't make very much. Maybe they report maybe $20,000, $30,000 in income, which isn't going to get them a house in California. But when you review their last 12 months bank statements or 24 months bank statements, we notice that their average deposit every month is, let's say, $10,000. Well, what we would do is we would add those deposits up. So assuming the same deposits were taking place every month, $10,000 for January, February, March, April, all the way to December, 12 months takes us to, $120,000 a year. 120,000 times 50% is $60,000. That's what they can have as far as their debt expense. That's what they can have for their debt to income ratio. That's what they can use to be able to qualify to be able to purchase a home. So, this allows them to be able to purchase a larger home and not have to wait another year to file their tax returns and maybe not take as many deductions as they had anticipated planning on doing. And, this allows them to still be able to get their maximum tax expenses written off, as well as to be able to still purchase a home, again, non-QM mortgage. So we've talked about DSCR. We've talked about 12 to 24 month bank statement program. We've talked about 1099 only program. What other non-QM programs exist? Well, there's a profit and loss statement loan where you just show the profit and loss. There's a 3-month bank statement loan. And then if it really comes down to it, there are 2 non-income showing loans out there. And then if it really, really push comes to shove, you can always tap into the world of private equity. So you can do soft money, soft hard money, or hard money. This is where you go straight to an investor and say, look, this is the collateral. This is how much I'm putting down, 20, 30, 35% down, and I'd like to purchase this home. And there's no income or assets even reviewed, and you're given a loan in a few days. Bottom line, there's a lot of other programs out there aside from just the conventional or FHA or VA or USDA or jumbo traditional loans that you've seen out there that have been marketed for decades. There's a ton of other programs that you may not even have heard of that are available. And if you are working with a reputable mortgage broker, or let's say you're not, please feel free to reach out to us. We are Kees Lending, and we would love to have a conversation with you and kind of go over your scenario and see what loan would be best placed for you. Thanks for watching. Thanks for hearing our podcast. Till next time.